Hi guys, it's Sam Norris here, the property investors broker and owner of Grand Union Finance, and I'm here with another property finance video. And on today's episode, we're going to be talking all things lockdown. What is going to happen to the mortgage market? So if you're interested in finding out my thoughts on what's going to happen, stay tuned and we'll go for it in a bit. Property is about patience. Hi guys, thanks very much for staying tuned. If you haven't already, before we get underway, please subscribe to the channel by hitting the little subscribe button below, as well as tapping that little bell, which will give you a notification whenever a new video jumps up. We usually go with 2 a week, so plenty to get your teeth stuck into. But before the credits, I was talking about how I was going to talk today about what's going to happen with the mortgage market as we enter Lockdown 2, the sequel. It's actually not all doom and gloom. I am actually pretty happy with what the situation currently is like in the UK. When we went into lockdown back in April this year, what happened was we kind of went into panic mode. Suddenly, in a very short period of time, the government basically said that everyone had to work from home. They couldn't go into the office anymore. Valuations were no longer able to take place. Lenders were really worried about the impact of the market, and so they were pulling rates left, right and centre. In actual fact, a lot of them were even basically declining applications or pulling applications that had already been submitted, and some had even had mortgage offers issued out. So the whole market was in complete turmoil as we got used to the new norm, or the, as I called it at the time, the temporary norm of this weird lockdown situation. Now, for those of you watching this that are suddenly thinking, oh my God, is the same thing going to happen again? The answer is no, it isn't. Please don't worry. You can breathe a sigh of relief. I think we're going to be okay. And here's why. So let's go through all the things there that caused a problem before, and let's see what the difference is now. So first things first, working from home. This caused a massive issue with lenders because some of them had never ever even thought about the prospect of having their workforce work outside of the office. And so many of them just had to take time out of accepting new applications so they could figure out what they were going to do with their workforce. Were they going to furlough them? Were they going to send them home? If they did send them home and they had to work from home, how are they going to, take calls or do their work and be able to do things securely? Because obviously they're dealing with really sensitive client information. So it took lenders a bit of time to sort this out. That's not going to happen this time round, because guess what? They've already done it. They've got all the processes in place to allow them to send their workforce back home. Pardon me, got a hair in my mouth. To work from home. All those systems are already in place, which is brilliant. It means as of today, as and when I'm recording this, which is Thursday, the first day of lockdown 2 in the UK, the lenders can send their workforces home again if they want to, because the government has stipulated that people can work in their office if they have to, and so some lenders may have some of their staff still working in their office. But on the whole, it shouldn't really cause too much disruption, fingers crossed. Let's talk about valuations. Now, last time round, valuers weren't allowed to enter homes. This time round, different story entirely. The property market is open still. The government have stipulated it is still open for business, which means estate agents are open. They can do viewings, which means transaction numbers can continue to move forward. Mortgage surveys can still go ahead because valuers can go into the properties. They're going to have to do all the normal safety protocols with their masks and all this kind of stuff. And it just means that they are going to be able to continue to do this. So we're not going to have that bottleneck of transactions that couldn't take place that we had last time, which caused big problem. Also, lenders are a bit used to the fact that we're now in coronavirus land, and things are a bit odd and a bit weird. We've also seen, lenders would have had a lot of comfort in seeing how the market has progressed since lockdown 1 came to an end. The property market has gone, we've had a bit of an artificial bubble, a lot of people are calling it, but transaction numbers are up. Mortgage applications are up. Average property prices are at an all-time high. This is giving lenders a little bit more confidence in the market as a whole. And this is major because it means that they won't this time be pulling their products across the board. That we are going to see a little bit of tightening up on criteria. Lenders that were a bit more flexible on certain things before might just not be as flexible. But a lot of this is actually due to how busy they are, not because they're worried about the market. We had Barclays not so long ago actually pull their 75% loan to value products. It wasn't because they were worried about the property market collapsing. It was because they were blooming busy and they just couldn't actually look after the huge numbers of applications that they were getting. So they thought, sod it, let's just get applications for 60% loan to value mortgages. Great, the risk there is minimal in comparison, and that's the reason they did it, not because they were worried about the market. So although potentially and quite probably we are going to be heading for what I'm calling a market correction, because we're just artificially a bit high at the moment. We should probably be about there, so moving back onto the natural course. We'll probably see stagnation stroke decreasing in property values for a period of time until we get back to that normal upward curve that we would normally have. But I don't think lenders are as worried this time round as they were last time round about how the market is going to react, because we've seen with the extension of the furlough scheme, the huge numbers of redundancies that were being predicted at the beginning of the year or beginning of lockdown haven't yet materialized. They may well do once we get out of lockdown 2 and people do start actually letting people go. Although we've actually had some interesting news recently that the government is saying that employers can rehire their staff that they have let go and put them straight onto furlough temporarily, so they can actually help the people that they've already made redundant out, which is an interesting little twist on the furlough story. But the furlough scheme has done what it set out to do, which is to stop mass redundancies, which would have had a negative impact on the economy and in particular the property market and transaction numbers. It hasn't happened yet. So as a result of that, we should be okay. Now, add into that I think the run into Christmas I think is going to be relatively busy because of everything that I've just mentioned. But also if we go into 2021, the first quarter in particular, we are then in the run up to the end of the government stamp duty holiday, where at the moment if you purchase a property less than 500,000 you don't have to pay stamp duty. Amazing. But that's coming to an end at the end of March, and if it's anything like when the government introduced the 3% surcharge on second homes a few years back, we saw a massive flood of new inquiries and applications coming in the 2 to 3 months before that deadline. And that was only when it was to do with the buy-to-let and investor market, which on average only makes up about a quarter of the entire market when it comes to transactions. This time around, it's the whole market. So I fully expect transaction numbers to be pretty high going into the first quarter of next month. And it's probably, next year. And it's probably after that we're going to see transaction numbers drop off a cliff a little bit, because that will have come to an end. They may extend it, who knows? But as things stand, that's when it's coming to an end. So plenty of reasons to be optimistic, guys. So if you are thinking about moving home, buying a new property, purchasing a new investment, even looking at a development project, things are looking good. Lending is available. We're not going through a credit crunch. There is trillions of pounds out there to be lent out, which is great news for investors and people that need new mortgages. It means that lenders want to lend it because that's how they make their money, and they will find ways of doing that. So lots of reasons to be optimistic, guys. I hope this has been really, really helpful. If you've got any comments on what I've just said, I would love to hear your feedback. So please put any comments in the comment comment box below if I can get my words out, and I'll respond to them in due course, but I'd love to hear what you have to say. In addition, if you have any questions about anything that I've discussed or anything to do with mortgages or any kind of other property finance, bridging development finance, commercial mortgages, reach out to me on Instagram at the Sam Norris, and I will be happy to answer any questions that you've got. You might just get a voice note back from me because that's the easiest way that I communicate with people. So, but anyway, guys, thanks ever so much for sticking around to the end. Remember to subscribe and hit the notification bell to be notified of all future videos. But for now, I will leave it there. Have an awesome week, and I'll catch you on the next video. Cheers.